here. So we are session 7 here in our semester number 4. We're going through terminology today. So we're going to just try to walk through and knock things out. So it'll be interactive. So to the extent we're going to go through, I'm going to ask you guys questions and we're just going to pivot back and forth. Everybody just chime in as you deem necessary. But what did we mean when we said T12? Do you guys remember what a T12 is?
Trailing 12 months.
Mm-hmm. And like, give me an example. Like what are we trailing 12 month on? What do you think?
The profit and loss statement.
Profit and loss statement. So, when you look at a T12, so if we look at an apartment complex, and this apartment complex we're looking at in June. And, so you've got all of 2021 profit and loss statements. But what you're trying to say is, well, gosh, how's it doing now over the last 12 months? Okay. So they're going to want to see a real time like T12 to try to identify like what is the profit and loss if we went back 12 months. So they're going to look at the rent roll and all these things to try to figure out what is most up to speed in a trailing 12 months. So that's really what they're going to focus on. Most lenders who are looking at these are focusing on the T12. What I mean by that is CMBS, life insurance companies. Those are the groups who will look at those things heavily. So just kind of note that as you go through. But that's a buzzword. You're going to hear, get me your T12. And you're kind of like, is that Terminator, from the movie? No, it's the profit and loss statement for the last 12 months. Okay. So any questions around that? Some of these things are pretty straightforward. Okay, just profit and loss. If you guys don't know this now, then, I don't know what you were doing in finance. So what's a profit and loss?
The total income minus the operating expenses.
Right. Yeah. So profit and loss, again, revenue minus expenses, operating expenses with net NOI. Now, remember, when you're looking at a property, that you're looking at what is the revenue, meaning the gross rents coming in. You're going to look at additional income potentially. So those could be CAM expenses, common area maintenance expenses that could be involved in it that we'll be talking about, and then whatever their operating expenses are. So you're going to be really looking at diving into those numbers, making sure you have a good feel for it. So, because a lot of times other income comes in and you go, oh, the math looks great. But the other income might be just late fees and things of that magnitude. So those don't really apply when we're thinking about a profit and loss. Does that make sense? Mm-hmm. So just be cognizant of that as you dive into these as well. Balance sheet. Give me your best shot at your balance sheet.
Your breakdown of assets, liabilities, and stockholders' equity, and like your snapshot of financial performance at a point in time as opposed to a time period.
Yeah.
As if you can pay off your liabilities and see if you're over leveraged.
Yeah. Yep, exactly. Yeah, assets, liabilities, owner's equity, right? It's a snapshot of time. You're looking, a lot of times they're going to look for what are those liabilities, current assets, current liabilities, what is the cash position of the entity, is there equity? Have they been pulling all the equity out? So those are things to be aware of when you're looking at these things. They're more applicable for businesses than they are just the real estate. So when you're looking at a business, you're kind of probably doing more of a deep dive on the balance sheet than you are just a traditional commercial real estate project. Okay. Okay, good. Let's talk about projections. What do we mean by projections?
So like with a pro forma statement, you're basically showing the lender kind of what your future projections are for revenue and expenses, kind of see like where your break even point is when you become profitable.
Yeah. And what kinds of scenarios would this be applicable in the commercial real estate world?
Trying to obtain a loan, like an underwriting process.
Yeah, and it would be for something like construction, right? There's no income in the past. So what are the projections going forward? Okay. This is also going to apply for somebody buying a apartment complex who is going to renovate the units. And then they need to project out what is the income going to be in the future? What are the rents going to be in the future? And so projections will be very applicable in all those different scenarios, okay? For businesses, if it's a newer business or an expanding one, that will be applicable as well, okay? So projections are a big, big deal. We just closed a $53 million loan Friday, and then we'll close another 100 million this week, and it was all based on projections. So a single family built for rent project, and we were all just trying to figure out what was the projected rents, okay, and expenses. So just things to be aware of when you're looking at projects, okay. Rent roll. Do you guys remember, Zach, do you remember what a rent roll is?
The summary of the property's tenants.
Yeah, so do you guys do you remember anything about like what the categories were in the rent roll?
I think it was like obviously like their name,
Rent,
square footage, when the lease stops and starts.
Yep, correct.
So they're like common area expenses, so like lobby, like pool, stuff like that.
Yeah, common area maintenance expenses are definitely part of those, can be, you know, depending upon what it is. So yeah, common area maintenance, square footage, because you're trying to calculate a rent per foot. Because you want to try to compare that with what would be deemed a market. All of a sudden somebody sends me a rent roll and I see that the rent per foot is 35 bucks a foot. And I know that area is like 25. Then I kind of like, what's going on? Why is it so much higher? So those are things we want to be cognizant of. The other thing to be aware of on a rent roll is the percentage of square footage that tenant takes. Now, why would that be a big deal?
sorry, what was the question?
So let's say that I'm a tenant on an office building, okay? And you've got, you know, 100,000 square feet. And I take 30,000 square feet. Could that be concerning?
Like you're saying, like as like one tenant controls too much of the lease. So like, for example, if they were to get knocked out, you'd be missing 30% of your business, which could be detrimental.
That's correct. So it's called concentration. So all of a sudden I have 30% of my rent roll is one tenant. Now, is that the end of the world? Not necessarily, you know, if it's a huge company. But if it's like, oh, this is a big mortgage company, you're like, ugh. If all of a sudden interest rates go too high and you just have to cut your business in half, you know, it's like, oops, we don't think we're going to take you. So those are things you have to know and be looking at when you look at a rent roll. You have to ask these tough questions. Who are the tenants? How many locations do they have? How long have they been in business? You know, have they been in there multiple times in your business? You know, what industry are they in? I mean, COVID has made you start thinking a lot more cynically. You know, it's like, is that the business that can go out of business real fast? Do you really need to be on site? You know, could you be remote? I mean, these are questions that people are asking now. You know, Amazon, it's like, could that be have the Amazon effect? Where all of a sudden this tenant is going to get wiped out because they don't need a physical brick and mortar, right? So these are questions you have to ask. So it's not just about looking at the rent roll, it's about having critical thinking and asking just simple questions like, does this make sense? So that's why rent roll is so important, because you're immediately scanning the tenants and just asking, who are they? You know, and are we comfortable with them? What would be something else you think you would want to know on a rent roll besides the tenants and how much space they take?
How many tenants there are?
Yeah, how many tenants is certainly a good one for sure. Diversification, right? What else?
Is there anything to do with like the income of each tenant?
Income could certainly be important. I want you to think more in terms of the time horizon that their lease is. What do you think?
So multiple years compared to like singular.
Yeah, well, think about it this. If you're an investor, so you and Ben partner up and you decide we're going to go buy a building. What are you're banking on the tenants being the kinds of tenants you're comfortable with, right? Strength wise, that they know what they're doing and they're going to stay in business. But the second thing is you're going to look and say, well, how long are their leases for? Because their leases all roll in a year and a half, then that could be risky. Because if they go, well, we're leaving, there goes your income stream, right? Because you're just like, well, wait a minute. You just left. Okay, because you only had a year and a half left on your leases. So does that make sense, what I'm saying?
Yeah.
So you have to think as if you were the one buying the property. What would you be concerned about? What would you want to know? Are they paying on time? I mean, that would be a good one, right? Like, I appreciate the fact you got a lease, but are you paying on time? Or not? Because if you're not, that lease doesn't mean a hill of beans to me. Okay. Yeah, back rent. Are they paying their CAM expenses? Do you guys know what I mean when I say CAM? Common area maintenance. Do you know what that means?
No.
I mean, that's just kind of what like the part of the property that like you don't necessarily have. So it's like not your like apartment, like your general apartment. It may be like your fees that cover like, I don't know, like parking garage expenses, pool, laundry, if it's not in your individual unit.
Yeah.
Security, whatever.
Yeah, exactly. It's all those common area expenses that, you know, you don't occupy, you could use, and then they divvy that up and then say you're going to pay that as a monthly fee. So, you know, depending on the percentage that you take. So if you took 30%, you're stuck with 30% of the expenses. Okay. So these are things to just, again, it's important to understand. Okay. Articles of organization. What's that all about?
To establish like an LLC.
Yeah, exactly. So it's if you go into a state, then they have requirements for you to be licensed and to do business in that state. So if I go into Arizona, I have to file a name, okay, trade name, and then I have to file articles of organization to make myself official. So Do you remember what kinds of things are on the articles of organization for an LLC? What do they need to know?
The members in the LLC.
Yeah, exactly. Who are the members? And their names, addresses, what's the name, what's it in business for? And then you have to publish that with the city or the state. And then you have to also do something where you're gonna have to publish it in a newspaper. So you have to kind of do this publication for the city or for the general community. So then it'll eventually come back, stamp it and say you're official, okay? And then at some point you'll get a certificate of good standing, which means that you're in good standing or you're not, okay? So it's important to understand it's the same thing with articles of incorporation. It's just for a corporation versus a limited liability company. Do you guys know what the difference between the two are?
So like an LLC, for example, it's not directly like you can't get sued directly. It's like the LLC. Whereas like a corporation. So corporation, like it can't go onto you at all. And the LLC, it goes after the LLC at first. And then if you like commit fraud or something else, then it goes on to you.
Yeah, good shot. It's so the LLC is definitely a limited liability, right? Like it's this entity that's set up. The distinction is that a C corp is has similar attributes, meaning that there is protection in it. The difference is this: from a tax perspective, when you're a limited liability company, they tax you at the income tax level. So whatever your personal income tax was, that's what you're going to get taxed at. On a C corp, you're double taxed. So you're taxed at the corporation level, then you're taxed at the personal level. So it's double taxation. That's why everybody loves the LLC, because it gives you the same amount of protection, but it also has taxes at one level, not two. Now there's some benefits for C corp in some different ways, but for the most part, that's probably the major distinction between those two. Do you know what I mean when I say that? Like corp gets taxed on its own, then it comes through to you as distributions, then you get taxed on those distributions personally, based on what your income level and tax bracket is. Does that make sense?
Yeah.
So when you go to get a loan, why do you think the lender needs to see articles of organization, LLC paperwork from you? Any ideas?
Is it to see like the different levels of protection in case you were to default on the loan?
Yeah, good shot at it. So think about it this. So if you, let's say that you guys you're borrowing money from me, okay? And you say, hey, I'm buying this property and I'm buying it in BC LLC, Ben Carlson LLC. And you say, and I say, great. We'll move forward. Well, one things I need to know for sure is if BC LLC actually exists, right? Because if it doesn't, then I'm lending money to something that doesn't even exist. And so now all of a sudden there's a major issue. Second thing I need to know is, are you in good standing? Because I might find out that you've been like doing all sorts of bad stuff and you're not even in good standing. And all of a sudden this paperwork is worthless because you're not in good standing. Okay. So it's officiality. The other thing I need to know too is that the only asset you own in that LLC? Or do you own other assets? Because if you own other assets in it, now I take on additional liability. Because if you default on the other loan you have in there, my entity gets jeopardized as well. See what I'm saying? So there's lots of things, due diligence, that lenders need to know about that LLC. And not to mention, they have them do opinion letters, attorneys, to make sure that that entity is valid and there's no way that they would do the loan and all of a sudden come back to find out they just totally lent to get something they couldn't. Okay, which is why you have to have the operating agreement. Because the operating agreement, do you guys know what an operating agreement does? So an operating agreement, now think about what it is an operating agreement tells the LLC how it's going to operate. Okay. It's kind of like operations. It's saying, here are the rules and regulations of the LLC. Here's what you can and cannot do in that LLC. Okay. So you can do this, you can't do that. Do I have the authority to borrow money? Does Ben and Zach have authority to borrow money? I don't know. Let me see the LLC. The LLC may say no, it can't. Well, then we got a problem. Okay. So you need to see both those documents. It also says ownership, how distributions get made, what happens if you guys hate each other and you want to break up, right? All these things are designed to tell the company how it's going to officially operate. Okay. Tracking with me?
Yeah.
Questions about that? So what is guarantee or non-recourse?
So like
Guarantee, what is that?
you're giving the lender the right to pursue you in the case that you default.
That's right. So you're signing a personal guarantee. Ben Carlson is saying to the lender, I personally am saying, if I borrow that $10 million loan, that if all of a sudden I default, that you have the right to come after me personally to get the money back. By the way, if it's you and Zach, if it is joint and severable guarantee, that means that they can come after you for 10 million, Ben, then they can come after Zach for 10 million. Okay. Can't over collect, but the point is you're not just on the hook for 5. You're on the hook for the whole 10. Okay. Plus damages, plus legal fees, plus whatever. Okay.
So the group guarantee, if you were to do a group guarantee, then they could just basically go after one person and then it's basically left on the other if you pay it all through in one.
Yeah, let's use it. It's a great question. So let's just say we have 5 guys. It's 10 million bucks. And each one of us comes in. The loan doesn't work out and they go after us. And they look at each one of us and they say, well, Dave Cotter has 10 million in cash. The rest of them have like 200,000 in cash. Okay. Who do you think they're going to go after?
You.
Yeah. They're going to spend more time on the guy that has most cash. And they're going to go after him and say, we're going to go to the place that we know we can get paid back. So that guy who just signed up for a 20%, percentage interest in this property just got a noose around his neck and he's screwed. Okay. And so when you do these things, there are things called limited guarantees where it's like maybe I say, hey, look, guys, love all you. We'll play golf, but you're not that special. So I'll give you a guarantee of, $2 million, but I'm not doing a penny more. And so then when you have to negotiate with the lender, and the lender has the document, so it's kind of like bifurcated or chopped up in those pieces. Does that make sense? So those are the kinds of things that really happen when things go haywire in loans, which we'll see
many-
more of soon. So
How many people can be on a personal guarantee?
could be infinite. I mean, here's the thing, when you get what's called the tenants in common, so where it means you could have, 10, 15, 20 people. At some level, the lender says, forget about it. I'm not going to go through the brain damage of doing 20 people I'm going to have to underwrite. That's why TICs, or tenants in common, you'll hear about them, are not well received, because there's just a bunch of people that probably shouldn't be in the property because they don't know what's really going on, but they just got thrown into this big pool of things so people can go get, properties. But you could get, as many as possible, but most lenders say, look, after 8 people, I'm out. I'm not gonna, that's just brain damage. Okay. So we've done TICs before. They're a nightmare. And it's a lot of work. Okay. But they can be done. What do we mean by non-recourse then? Recourse is a personal guarantee. What's non-recourse?
They can't go after you personally. They can only go after like your LLC or your specific business or property.
That's right. BC LLC just took title of the property. It is going to sign the recourse carve-outs. So it says, okay, if this defaults, doesn't go well, then we're going to foreclose on the property. Okay, because think about sequence. They foreclose on the property. Let's say you had 10 million loan. Now the property is worth 8. Okay, so what's the gap?
2 million.
$2 million. So 2 million of deficiency. In the case of the recourse loan, they're going to go after you guys for the $2 million because they liquidated the asset. So they foreclosed, took it back, liquidated the asset, got their 8 million back. Now you got a judgment deficiency for the $2 million. Now they're going after you for the $2 million. Okay. In the case of a non-recourse, they say, well, too bad, so sad. They may come and talk with you and try to pressure you. And you say, guys, I'm sorry. I want to help you any way I can because I'm going to be in business long-term and I want to just walk away from obligations. But, at the end of the day, I'm not on the hook. That's part of the risk. I paid more money for it and I got a non-recourse loan.
So is non-recourse not very common, or is it?
It's very common depending on the type of lender. So CMBS lenders, that's all they do. Life insurance companies, half of what they do. Banks, rarely ever see it. And if they do, they jack the LTV down. So they're like 50% loan to value because they just want to minimize their risk. Okay. So it's, you just really need to know about guarantees. And then there's everything in the middle, like recourse, non-recourse. And then you've got top 10%, 20%, there's partial recourse, all sorts of stuff. Okay. And these guys could negotiate a million different things. Could be burn off recourse where you start off recourse. And then once you get to cash flowing, they can burn it off. Once you hit certain hurdles where you don't have any anymore. So there's just a bunch of different things. We've done a lot of it. Okay. So it's a hot topic. Once you become a developer, you get your butt handed to you in the middle of a recession. Next time you come around, you're like, I will never sign a recourse loan again, right? So, and you'll see that. Kind of like when you touch a hot stove and you're like, never do that again, right? So it's just something you have to be aware of. Make sense?
Yeah.
So questions around that at all? Okay. So personal financial statement, what is it?
Basically just a person's financials, which is like cash, receivables, real estate, like cars, boats, and everything.
Well, I want you to think about this. A personal financial statement is tantamount or synonymous to a balance sheet for a business. Assets, liabilities, net worth, which is owner's equity, right? So what are their cash, real estate assets? What are the ownership of their stocks? What are the ownership of their businesses? Liabilities, auto loans, credit cards, mortgages, car payments, the yacht that you and Ben are going to buy right after school, right? So all these liabilities, okay, and then you take your assets minus liabilities, owner's equity, okay? So here's where people get screwy, is that what they'll do is they'll take something that's supposed to have its own balance sheet because it's in a separate LLC, and they will put it on their personal financial statement. Why is that a problem? What do you think?
Are you saying like if they own a business and like let's say like it's a business asset and they put that on their own personal, there's a like tax benefits or
Well, it's a problem because it's double counting. We think about it. That entity has its own balance sheet, and then I'm also taking that and I'm putting on a personal financial statement. I'm double counting it. Does that make sense? Because it's already been on, it's already somewhere, but now I'm putting it in another place. So it's like you're double counting it ultimately. Now, there are cases where you could make the argument, say, look, it's single member LLC. I don't do a balance sheet for it. It's just going on my personal. That's okay. You can certainly walk through that. But officially, from a accounting perspective, that is inaccurate. So you have to be aware of that because it happens all the time. And you need to have people do it the accurate way so you're accounting for it. Now, the right way is you take the assets minus the liabilities on the balance sheet, take the owner's equity, and that owner's equity ends up on the asset column of the personal financial statement. Does that make sense? Taking the net worth, and you can put that on there because now you're showing the net equity that you own in that business because you've already accounted for liabilities on the balance sheet. You guys tracking with me? I don't want to confuse you.
Mhm.
Is this making sense, Zach, or not?
Yeah. So what is the problem with double counting?
Well, let's say that I don't know that the asset's the same. And all of a sudden I say, well, gosh, this guy's worth 2 times what he really is. Because all of a sudden I counted your balance sheet once as your net worth and liquidity. And then I count it again because I'm looking at your personal financial statement. So what's happening is I'm double hitting it. So it's not fair. And it's not a true representation of what their personal really net worth is, because I'm hitting it twice. Okay. Does that make sense?
Yeah, and so when you see that, then there's a better chance of them getting a greater loan, and that's why the problem is.
Well, the problem is that it's not an accurate representation of their true net worth.
Okay.
Or I'm also, to the converse of them, it's going to show loans twice when they only should have one. Because if they have a loan on one and then we hit it again, I'm hitting them twice for a loan payment when there should only be one loan payment. So what I'm doing is I'm impacting their income. It's kind of like if you said, let's say you and Ben bought a property and it was a multifamily property and you owe $2 million. And let's say your payment is $20,000 a month. Okay. And you came in, you're trying to do a loan, and you basically say, okay, my cash flow is X. And I say, well, the problem is, based upon the documents you gave me, you actually have $40,000 a month in payments. So you don't have the income to support it. And you're like, wait a minute, 40,000, what are you talking about? I said, well, yeah, because I looked over on your income statement or your personal financial statement, and then I'm looking at your balance sheet, and it's showing you have 40,000 in payments. And you're like, well, I only have 20. I'm like, well, something's wrong. Well,
So there's no benefit to it at all for people to actually do that.
well, it could be a benefit. It's just a fallacious benefit, meaning that it's not accurate. It's
Okay.
a false representation of your situation. Does that make sense what I'm saying?
Yeah.
Yeah. So you have to be aware of it when you're underwriting a personal financial statement, because it happens all the time, even with people that have a lot of money. So don't be deceived. Okay. So do you guys have any more questions around that?
I don't think so.
Okay. A lot to consider, huh?
Yeah.
And I haven't even scratched the surface, by the way. So if you get in this business, you're going to learn a lot of stuff that you're just going to go, oh, I didn't even know about that. So what's a K1? You guys know what a K1 is?
Federal tax document.
Yeah, where does it come from?
I know it's filled out by each individual partner.
Uh-huh. But what is it doing? What is it showing us?
Like incomes, losses, dividends,
Yep.
the different partners or S corporations within that.
Yeah, so if you guys have a partnership at the end of the year and you're 50-50, you need, for tax purposes, they need to see K1 distribution forms. So they can see if you guys made any money or lost any money. Okay. And so if you made money, you're going to get, let's say, $100,000, that's 50-50. You're going to get a K1 distribution of 50 grand. You're going to get a K1 for 50 grand. And then your accountant is going to take that, put that on the personal 1040 to show your income, Schedule E, and which will be taxed. Okay. You guys tracking with me on that? So if you have a K1 distribution and you're going to get taxed on that, or not, maybe, if I show a loss on my K1, do you think that's an actual loss in real life? Potentially, or not? I'm kind of giving you a little bit of a tricky thought here. So I give you a K1. So the K1, and all of a sudden K1 there's a distribution of the K1 and it's a loss. Is it an actual loss? Like financial loss? What do you think?
I want to say no, but I don't know.
Okay, so think about this. So let's say that you guys buy a property and let's say you're making 50,000 bucks gross. And you go through your expenses, you got property taxes, management fees, and you have a line item on there. So let's say your expenses are 40,000. Okay, so how much is your profit?
10.
So 10. Now let's say that I am your accountant. I say, hey, you guys have depreciation you can write off on this expense line item of 20,000. So what would be your profit in that situation? You just added another 20.
30.
Well,
If it's
it's an
negative.
expense,
-10.
Oh,
negative 10.
yeah.
So my question to you is that truly a loss? Or is it a paper loss?
It's a paper loss.
Yeah.
Helps you out in terms of taxes.
Yeah, you didn't really lose 10,000 bucks. You did from an accounting perspective, but you didn't really lose 10,000 bucks. Because depreciation is a non-cash expense. You're not actually writing a check. Does that make sense?
And you're just slowly amortizing it off the books.
Yep. So again, if I get that loss on the K1, praise the Lord, you're not going to pay taxes on it. But from a lender, they're going to want to know, okay, well, did you really lose money or did you not? Okay. So just something to be aware of on K1s, because I get lots of K1s, they show massive losses, but it comes from like an NOL carry forward from years before. It's not an actual loss. I mean, it was at some point, but it's just a paper loss. Okay. So just again, little something to notate on K1s. Okay.
So in terms of like your perspective, what, like, are you wanting to see a loss? Or
From whose perspective?
from like Integrity Capital's perspective?
From ours, we want to see as much income as possible.
Okay, so you don't want to see any loss after the depreciation. Gotcha.
Well, but again, if I'm doing my job right, it doesn't matter. Meaning that if I dove into their profit and loss statement, I would see that's a paper loss. And all I would do is add that depreciation back in and say, you were cash flow positive. So it doesn't matter to me. Good for you. You didn't have to pay taxes, but we don't care because we know that that's not a cash expense. So that's the thing that I would look at, when all is said and done.
So you don't mind it at all?
No.
Okay.
Now, if they have actual losses, we do.
Yeah.
You're kind of like, okay. Now, if they're turning a corner or they were doing a projection and then it's just going to take a while, that's okay. But you're definitely wanting to know. I mean, think about it at the end of the day. You're just trying to figure out cash flow.
Mhm.
Is this thing cash flow or does it not? Is this person cash flow or do they not? If you did a global analysis on all their properties and all their personal income, trying to figure out, are they robbing Peter to pay Paul? Like if you are literally losing money on a property, that money has to come from somewhere, right? I mean, it doesn't just pop out of thin air. So either you got a ton of cash and you're just dumping it, right, till you can turn a corner, or you're pulling it from some other property. But somehow, some way, people are having to pay for that loss. So that's what you need to be aware of. Cash flow. Okay. So you just have to notate that. Okay. So other questions around that?
Good there.
Okay, so certificate of good standing just tells you, like from the articles I said, it's just telling you whether it's in good standing with the state. Why that is, if it's not, you'd have to find out. They not file their annual report with the state. It's usually not a big deal, but it could kill a deal. Because if they don't have a good standing, they're not going to be able to issue loan documents against an entity that's not in good standing with the state. So they have to go rectify that. Okay. And it happens more often than not. Be surprised. I'm like, oh, you're not in good standing. A lot of times they don't even know it. They don't even know they're not. So it's like, oh, I didn't know I was in bad standing. It's like, okay, good. Let's go get you fixed. So what's a payoff letter?
What the lender collects to determine how much they need to pay off.
Yeah, exactly. Pretty straightforward. It's just saying, look, we got to pay the loan off. I need a demand letter. Please get that to me. Okay. Do you guys remember in the video what I said about trickiness of payoff letters? I'm going to make you guys think here. I'm going to sweat some bullets for just a minute.
Definitely to do with refinancing.
Huh?
I know like it has something to do with refinancing.
Well, okay. So let's say I'm the borrower and I have a lender and, I'm not in good, like there's some issues going on with the lender. I may not want to tell the lender I'm paying them off right away. And so, because they might give me a hard time or make it difficult or whatever it is. So sometimes it's the borrower says, hey, I don't want you to contact the lender yet because I want to wait till the last minute and then pay him off, right? Now, quite frankly, that gets a little fishy to me. If someone says that to me, I'm like, okay, that's not good. What happened? Why are we doing this? Now, they might have a legitimate reason, but it also raises a red flag. So I just always want to know, like, why are you wanting me to wait? Because a lot of times I want the payoff letter ASAP, and I'll tell you why. If they have a prepayment penalty and they don't know they do, their payoff could be dramatically higher than what they're telling me. And I might be doing a loan for 10 million, but in actuality, it's 12. Okay. And it's like, oops. And now you went all the way down for 45 days and you have a gap of $2 million. Well, that's problematic. Okay. You guys tracking with me on that?
Yeah.
So we definitely want to get that fast. Okay. Do you guys remember service letters? What's a service letter?
It's just like a contract between the third party vendor and the property owner. So like your pest control, your landscaping.
Yeah, not a whole lot there that you need to do. But it's just, yeah, third party contracts. UCC filings. What's that?
It kind of like determines the priority of assets that can be seized. Like if you were to default. It's like if you have multiple lenders, like it determines the pecking order of like who gets what first.
Yeah, exactly. So UCC filing is like, look, when you're on a property, you've got a deed of trust. When you're on a non-real estate property, you take a UCC filing. So it's Uniform Commercial Code. They're going to file on the assets for the actual business, like, equipment in the business, other things that might not be fixed to the real estate, furniture, things like that. That could all be part of the UCC filing. So you have to go look and see, do they have liens on their assets or not? Okay. So you just need to be aware of that. If there is a blanket UCC filing on there, you'd have to pay that off before you get to take a lien on the other assets. Does that make sense? Okay. So UCC filing, sponsorship. What is a sponsor?
Isn't that the same as a borrower?
Exactly. So same as a borrower. This is just kind of fancy, like who's the sponsor? I don't know. I don't even know who came up with that, but people use it all the time. So you just kind of, if you hear sponsor, don't think in your mind, well, gosh, who do I need to sponsor? It just means borrower. Okay. So not a whole lot there. Par. Now, Ben, don't get excited and think, oh, that's a golf term. But there is some truth to that. But what does par mean?
Like the lender's giving you or quoting you for the loan at like its face value, so you're not going to be charged any origination fees or anything like that. It'd be like $1 million loan.
Yeah, what happens is par means the lender is saying, look, I'm not charging a fee. And it's just going to be whatever you charge to the borrower. The challenge we could have with that is they might be jacking the rate up to get to par. So we have a problem with that at our firm, because that means the borrower is going to get hit to try to get no origination fee. And they'll pay more than they would pay over the life of the loan as opposed to paying the fee up front. You guys tracking with me on that?
So it's kind of just like a tricky way for banks to lead people on, when at the end of the day, it's really going to hurt them.
It is. Yeah, because almost every brokerage firm in the industry doesn't care. They're like, in fact, they'll say, jack it up as high as you want. If you pay me fees on the backside, they never know about it. Great. We don't like that, because it feels like I'm taking advantage of you and you don't know why.
Mm-hmm.
It also makes me so that my motives are impure about where I'm going to take you. Because it's like, well, if I have this bank and it's a better deal, but this guy's going to pay me 3 points, I'll go here. Right. So we're just trying to get rid of that. Say, we just want to go where's best for you. And then we don't have to get into this mumbo jumbo stuff. Okay. So par. Now there's many lenders we just say, look, quote par and say, we don't jack rates up. It's just par and we're fine with that. Like, great. Perfect. But if they start getting into the sort of yield spread premium stuff, we get really, my guys know I'm like, nope, no way. If they want to pay you a fee and they want to eat it, we're fine with that. But we're not going to be okay with jacking rates up. And, it's just not, I just don't like the feel of that. It just doesn't feel like we're representing people. Okay. So does that make sense?
Mm-hmm.
Okay. So we're going to stop there for today. And